If you've ever found yourself juggling multiple debts, each with different interest rates, due dates, and creditors, you know just how overwhelming and exhausting the whole situation is. Trying to keep track of all these debts can feel like navigating through a maze blindfolded, leading many people to the strategy commonly known as debt consolidation. But is this really a strategy that someone who is struggling with multiple debts should turn to? Well, in today's video, we're going to dive into the debt consolidation strategy. We'll cover off how it works, but most importantly go over some of the key pros and cons that each individual should consider before committing to a strategy like debt consolidation. For those new to the channel, welcome to Concepts Made Simple, where we aim to simplify everyday financial and self-improvement topics. If you're looking to get control of your finances and make smart financial decisions, be sure to like and subscribe to the channel down below. Before evaluating the pros and cons of debt consolidation, it's important to first understand what the strategy is and why dealing with multiple debts can be so overwhelming. On a surface level, debt consolidation is straightforward and is exactly what it sounds like. Instead of dealing with various creditors, due dates, and interest rates, debt consolidation streamlines your debt repayment into one monthly payment. The goal is to secure a consolidation loan, which will then be used to pay all existing debts. Once your existing debts have been paid, you will then be left with one larger loan, which is essentially representing all your previous debts combined into one. But you're probably wondering, what difference does it make if I still end up having the same amount of debt? Well, the benefit of debt consolidation can really be broken down into two distinct categories: psychological and financial. From a psychological perspective, managing several debts at the same time can be like trying to solve a complex puzzle. For example, imagine you have 5 credit cards, each with different interest rates ranging from 15 to 25%. They also each have different due dates, which are spread throughout the month. You might find yourself constantly calculating minimum payments, tracking due dates, and how each of these debts affects your overall financial situation. This mental burden can quickly lead to stress and anxiety. By consolidating debts, one can simplify this complex puzzle. By doing so, this can potentially help reduce the mental burden that one faces and ultimately create more clarity around a person's debt. But the benefits of debt consolidation are not only psychological. The strategy can also potentially help individuals save on interest and improve their credit scores. With debt consolidation, there's potential to secure a lower interest rate. If your new consolidation loan has a better rate than your existing debt, you could potentially save money in interest payments over time. Let's say your credit cards have an interest rate ranging from 15 to 25%. If you consolidate these debts into a single loan with an interest rate of, let's say, 10%, you're saving money over the long run. This could be substantial depending on the size of the debt. However, this also leads us to one of the key cons of debt consolidation, which is qualification requirements. Consolidation loans with favorable terms usually require a good credit score. If your score is low because of missed payments or high debt, qualifying could be challenging, and the interest rate may not be much better than your current debt. Regardless of your situation, improving your credit score, reducing existing debts, and demonstrating steady income can increase your chances of qualifying for a more favorable consolidation loan in the future. But if an individual is able to secure a consolidation loan, it can positively impact their credit score. When you consolidate, you're paying off your smaller loans, which can directly impact your credit score as it lowers your credit utilization ratio. As well, with no longer having multiple due dates to remember, it's easier for individuals to keep track of their payments, which in some cases can help people avoid missing payment dates on their loans, which in turn can positively impact one's credit score. However, along with stiff qualification requirements, there are other drawbacks that individuals should consider when it comes to debt consolidation, and a major one being the risk of accumulating more debt. The psychological relief of simplified payments might lead individuals to overspend on non-essential items, while the availability of credit from paid-off accounts can encourage impulsive spending. Without addressing underlying financial behavior, individuals may fail to change their spending habits, which can result in them ending up in a worse place financially than when they started. And lastly, debt consolidation can potentially lead to a longer repayment period depending on the terms of the loan. This can have a negative impact for several reasons, such as delayed debt freedom, reduced flexibility, and risk of interest changes over the long run. All in all, on a surface level, debt consolidation can seem like a very straightforward and simple strategy. However, there is many different variables that everyone should take into consideration before ever committing to this strategy. Just like with making any important financial decision, it is always recommended to speak with a licensed financial advisor who can help you weigh the pros and cons before committing to any strategy. Thank you for watching today's video, and if you found the video to be helpful, it would be greatly appreciated if you could like the video and consider subscribing to the channel.